Welcome to the deep dive. It is Tuesday, December 2025, and the market is giving us almost nothing on the surface. It's classic neutral sentiment.
It really is. The headlines are quiet. But our job today is to look at the plumbing, right? To get under the hood.
Exactly. We're not reacting to headlines. We want to build a proactive framework. We're digging into the market structure itself.
That's the only way to do it when momentum is this flat. It's all about the subtle signals. We're running an institutional scan looking for pockets of instability.
Pockets of instability. I like that. So we're talking liquidity, volatility, and some really interesting correlation breakdowns.
Yep. Those breakdowns are forcing PMs to completely rethink their hedges. This is about seeing the risks before the opening bell forces your hand.
So we're basically walking through a top-tier portfolio manager's pre-market checklist. Where's the capital flowing? Where's the risk? And I think this is key. Where does the average trader get trapped?
That's the game. Spotting the subtle shift from, a stable market to a disorderly one.
Okay, so let's start right where any institutional day has to begin. The microstructure. We're talking equity futures, ES, NQ, RTY. What is the pre-market liquidity scan telling you right now?
Well, the environment is precarious. Pre-market is always lower liquidity, wider spreads. That's a given.
So any big order is going to move the market against you.
Instantly. So we're really focused on two things. First is the order book depth on exchanges like CME Globex. And right now, the books are thin.
Thinner than you'd like to see.
Oh, much thinner, especially around the overnight high and lows.
Yeah.
And as you know, thin books mean you can get these huge amplified moves on really low volume.
It doesn't take much to shove the price through a key level if there's no one there to defend it.
Precisely. A small order can paint a very misleading picture. The second thing we're watching is volume at key levels.
Okay.
We're looking at the volume traded overnight, right around yesterday's close. If you see a ton of volume there, but the market can't move away from that price.
It tells you that any buying pressure is just getting soaked up by bigger sellers.
It's being absorbed by institutional supply.
Exactly.
It's a huge red flag for any early optimism.
This is where things get really interesting and, frankly, a bit aggressive. The liquidity grabs and the idea of trapped traders. Break down how these grabs actually work.
A liquidity grab it's sophisticated stuff. It's a fast, low-volume spike, usually algorithmic, designed specifically to trigger stop-loss orders.
So they know where the stops are clustered.
Of course. The stops are visible liquidity, so the algorithm pushes the price just far enough to hit those stops, grabs all those sell orders, and then immediately reverses direction.
Wow, so they are literally manufacturing a false move just to prey on predictable stop placement. It really is algorithmic warfare.
It absolutely is.
Yeah.
And the people on the other side of that trade, they become the trap traders.
The ones who chase that false breakout.
Exactly. They saw the price breach the overnight high, they jumped in thinking it was a real breakout, and then boom, it reverses. They're instantly underwater.
And we can spot this by looking for what? A high volume spike at the highs that just fails.
That is the tell. A massive volume spike, right at the extreme that can't hold. It means all that aggressive buying was absorbed, and now those buyers are vulnerable. They're the target for the rest of the day.
Okay, let's pivot a bit. From execution risk to systemic risk, let's talk volatility. The spot VIX is just sitting there, around 16, 17. Total neutrality.
Yeah, but the spot fix is mostly noise.
Yeah.
You have to look at the term structure. That's the real roadmap for forward expectations.
And the structure is in Contango, which is normal. Longer dated futures are pricier, no panic.
Right, we're not seeing backwardation, which would be a 5-alarm fire.
Yeah.
But the slope of that curve is telling a story.
It's not a picture of perfect health.
Not at all. The front end, the next 1 or 2 months, is pretty flat. And that isn't complacency. That's persistent structural uncertainty.
Why? What does the flatness tell you?
It tells you that traders who own that front month protection, they aren't willing to sell it cheaply. They might not see a crisis tomorrow, but they're hedging things like the debt ceiling debates next quarter.
So they're hedging known unknowns. It's not a reaction to a shock.
You've got it. And then if you look further out, the curve gets a little steeper. The VIX contract for 6 months out is getting bid up.
And that suggests?
That suggests institutions are actively buying protection against policy mistakes, or maybe a deeper recessionary risk in late 2026. They're hedging the macro-level turbulence they see coming down the line.
Okay, so this all feeds into the market open itself. Let's talk about the implied opening range. That's a huge institutional benchmark. How does it work?
Yeah, it's a crucial anchor. And it's less of a strict formula and more of a conceptual consensus.
The market's best guess of where things should open.
Exactly. It's basically yesterday's cash close plus the difference between where futures are trading right now and their fair value. It's the overnight narrative, all baked into one number.
And its real value isn't the number itself, but watching how the market reacts to it.
That's the whole point. If the cash market opens with a big gap way outside that implied range, it tells you the quiet overnight consensus just got rejected.
It means aggressive money showed up at the bulb.
And that means you have to reevaluate everything fast. It's a signal that volatility is about to explode and conviction is suddenly very high.
All right, now for the really complex part. The cross-asset correlation breaks. This is where it all comes together. We have this really contradictory pattern. Equities are sort of up, but yields on the 10-year Treasury are down and the dollar is strong.
It's a mess. It really defies the textbooks,
Right. Risk on is supposed to be stocks up, yields up, dollar down.
And flight to safety is stocks down, yields down, dollar up. We're getting bits and pieces of both, and it's creating this really disorderly picture.
It sounds less like a coherent strategy and more like just a global scramble for liquidity.
I think that's a great way to put it. It screams global fragility. The falling 10-year yield is a classic flight to safety. The bond market is nervous.
And the strong dollar, the DXY, backs that up. It's a rush for dollar liquidity.
The world wants dollars and high-quality collateral. But here's the puzzle, right?
If there's such a strong risk-off bid for bonds and the dollar, why aren't stocks getting hammered?
Because the strength in equities is incredibly selective. It's not a broad rally. It's all concentrated in mega-cap quality names. Companies with bulletproof balance sheets.
So small caps and cyclicals are getting left behind.
They're getting crushed.
Yeah.
It's a very cautious defensive rotation within the equity market, with the U.S. dollar acting as the ultimate safe haven for everything else.
This shift brings us to the traditional safe havens that seem to be broken. Let's talk about gold and Bitcoin. They are not acting like they're supposed to.
This is a critical breakdown to understand. Let's start with gold.
Okay.
It's flat to down. And that's happening even with two major tailwinds, falling real yields and a strong dollar driven by fear. Historically, those are both good for gold.
So why is it failing now? What's different?
I think the simple answer is just overwhelming USD dominance. The institutional demand for dollar liquidity is so immense that it's sucking all the oxygen out of the room. Gold is being left behind.
And maybe disinflation fears are playing a role. The lack of an immediate inflation threat.
That's the other part of it, yes. Gold's utility as an inflation hedge is being heavily discounted right now.
Okay. And then we have the so-called digital gold. How is Bitcoin holding up in this stress test?
Bitcoin is failing the test, unambiguously. It is trading like a high beta risk asset, period.
It's not a hedge at all.
It's the opposite of a hedge. It's falling, and its price action is tightly, positively correlated with the worst performing parts of the equity market, the cyclical and high growth names. It offers zero diversification right now.
So the whole digital gold narrative for institutional portfolios is, for now at least, completely broken.
For now, it's dead in the water. It's just another risk-on asset.
So given this really messy, disorderly environment, the dollar is king, old hedges are broken. What's the actual strategic playbook? How do you generate alpha here?
You have to be defensive, but also opportunistic. The core thesis is to be long volatility skew.
Okay, break that down.
It means we're buying out-of-the-money puts on the major indices, but we're funding that protection by selling out-of-the-money calls.
So you get the downside protection without paying a huge premium for it.
Exactly. You're taking advantage of the fact that volatility almost always spikes higher and faster in a crash than in a rally. For allocations, you have to favor quality growth.
The companies with strong free cash flow, solid balance sheets.
The ones that can survive a liquidity crunch. And finally, you have to actively hedge credit risk. We're looking at targeted, short-dated credit default swaps on some of the more vulnerable high-yield corporate bonds.
Basically buying insurance against corporate default.
You have to protect against that credit dislocation.
We know the market consensus is pricing in a soft landing, with the Fed maybe starting to cut rates late in 2026, if that's what everyone expects. What's the biggest pain trade that would catch everyone off guard?
The pain trade isn't a deep recession. Everyone's kind of prepared for that. The real pain trade is a violent repricing of sustained higher interest rates.
The higher for longer scenario actually coming true.
And not just longer, but maybe even a little bit higher. Imagine if inflation proves to be stickier than anyone thinks.
What would cause that? A wage price spiral. Another supply shock.
Both are possibilities. If that happens, the Fed is forced to stay restrictive deep into 2026, or maybe even deliver one more surprise hike.
And the fallout from that would be
It
enormous.
would be systemic. You'd see a violent sell-off in bonds yields would spike. That would crush equity multiples, especially for growth stocks. And the dollar would just go on a tear. It would be a complete, painful unwind of the soft landing narrative.
This has been a fantastic roadmap. I think the key takeaway for you, our listener, is that when the surface looks this calm, this neutral, the real focus has to be on the hidden indicators. It's about that tightening liquidity, the story the volatility skew is telling, and this failure of traditional hedges.
And that failure leads to a final provocative thought. The market right now is showing us the US dollar can absorb nearly all of the global flight to safety demand, leaving assets like gold and Bitcoin completely behind. So the question to think about is this. If that dollar dominance persists, does it fundamentally break decades of portfolio theory? Does it force institutions to permanently change how they define a true hedge? That's what we'll be watching. We have to remain vigilant.